I don't understand. I cannot compute the valuations. I don't understand them. I cannot justify to myself the validity of those valuations.
This year, Neil Woodford made a series of calls that went directly against the market consensus. People thought he was wrong. But the numbers so far tell a different story. And now, as the AI bubble narrative heats up, he believes investors could be making an even bigger mistake.
I said at the start of the year that the way to play the AI industrial revolution was not to jump into the obvious plays. When valuations are as high as they are in the Mag 7, you've got to tread with caution.
Over 25% of the S&P 500's weighting is taken up by the 5 biggest companies in the index.
There are 493 stocks which essentially have gone nowhere for 20 years.
Let's meet the Magnificent Seven. These are not your average companies.
If everyone is talking about it like it's a bubble, and everyone thinks it's a bubble, why is everyone continuing to act like it isn't?
Even though we've had another good year for the S&P 500, if you are crowded into the S&P 500, you're crowded out of other things that I think will continue to do better.
But it's not just about overvalued US tech. It's about something much bigger.
This AI industrial revolution and the excitement around AI has a lot further to go. This is a play for economic and industrial dominance, and nobody's going to jump off this bandwagon. There are inevitably going to be disappointments. Not all of these global tech titans are going to win.
OpenAI is a train wreck.
Yes, some expectations are entirely unrealistic, but this isn't 1999.
Yeah, it's a lazy comparison.
You made a series of calls at the start of the year. Some of them were quite bold. And I think enough time has now passed that we can actually test whether those calls were right or wrong. And the first one was about semiconductors. And it's hard to believe sitting here now in November that talking about the semiconductor sector and expecting that to perform well was a contrarian call. But you said the real opportunity was in the picks and shovels side of AI, the fabrication and the equipment suppliers. They've had an extraordinary year, but that wasn't a given at the start of 2025.
Not at all, no. There was a sort of gloom over these sorts of businesses, and I could list them. I mean, on my list of sort of favorite companies that I wanted were companies like ASML, ST Micro, Infineon, Renesas in Japan, Micron in the US, SK Hynix in Korea. Well, all these companies were in the doldrums, really, and in part because the semiconductor cycle, which is a very cyclical industry, has been through a difficult period with excess inventory and weak pricing. And I think investors generally had sort of become quite negative about the outlook for this sector, and certainly weren't that optimistic about a sort of turn in the cycle, in the inventory and pricing cycle. I didn't sort of quite get that argument and saw this group of businesses, all really suppliers to the AI industrial revolution, all quite different in some respects, but each having an important role in being picks and shovel suppliers to that industrial revolution. ASML, you couldn't really describe as a pick or a shovel. I mean, these are some of the most sophisticated machines man is capable of producing. But nevertheless, all these companies I saw having lots of valuation upside and lots of operational and revenue and profit upside. And that has proved to been right. That call was right. The valuations have expanded this year. They've all done very well. The valuations have expanded, and in some cases are not as attractive as in quite a few cases, not as attractive as they were at the start of the year. But I still think there's more to go for in that group of businesses.
You also said that the post-election sell-off, post-Trump election, that is, sell-off in renewables was way overdone, and those stocks have bounced extremely hard. Is that simply the reset that you expected to happen, or is there something else at play?
The bounce back has been more aggressive than I thought it would be. And that's partly because, in a way, I've been lucky to some extent with that call, because although I felt that there was a significant level of upside because they've been smashed so badly in the period between Trump winning the election and the sort of the first policy announcements, and when it became clear that the Biden renewable subsidies were going to end effectively. What's actually happened is there are a number of things. First of all, the subsidy regime actually, although the subsidy regime has changed substantially, in fact, what's happened is that the subsidies were effectively tapered rather than ending, which was a significant win for the industry, tapered out to 2030. But also in the meantime, what's happened is that because the cost of particularly solar with battery storage has fallen so significantly and is now competitive with new gas-fired generation costs effectively. What that means is that the cost advantage of solar energy in particular in the US has improved significantly. And so more investment is now going into solar with battery capacity. And just as a result of that price competitive shift, the industry is beginning to recover more quickly than I think analysts had thought right at the start of the year. So there's really been quite a significant move. Now, it's not just, I mean, some of the leading companies in this space are not just US companies. Some of them are international, like Fluence, for example, is a global business. It has a big business in the US, but it is also winning contracts now in Europe, in places like Germany and Poland, for example, and indeed in Ukraine even. Yeah, that recovery has been more significant and more rapid than I thought.
Biotech was another sector that you mentioned. You linked the opportunity there to the 2030 patent cliff that biotech firms and big pharma is facing. Are we starting to see that cycle play out yet, or is it too early?
It's a little early, but I think it is beginning to play out. The big pharma companies in the US and in Europe are beginning to open their wallets and go shopping in the biotech sector. So there have been a lot of deals this year. There was quite an interesting bidding war for a biotech company recently between Novo Nordisk and Pfizer. The price outcome from that bidding war was really quite shocking, really. Novo Nordisk eventually stepped away, but nevertheless, it does reflect, I think, the fact that those big pharma companies are increasingly, obviously, very aware of that patent cliff that's coming in 2030. It affects nearly all of the largest pharma companies globally, and they're all going to go shopping for biotech companies at some stage. The biotech sector has not performed anything like as well as the renewable energy sector in the US, or indeed, of course, the AI picks and shovels companies that I've been talking about. But in here and there, it's actually done quite well. And I think there's lots of sort of company specific reasons why there's some really interesting businesses here. In a way, investor attention has been focused elsewhere, but I think it will come back to this sector and come back to these companies in the months and the years ahead.
Okay, that's a good review of your early year calls. For the next part of this episode, I want to talk about something completely different, but it's something that is preoccupying the minds of pretty much anyone, I guess, who's reading the news, the financial news at the moment. And that is the comparison between what's happening now in the technology sector, particularly in AI, and the link to the dot-com era. I want to talk about how the dot-com bubble actually unfolded and what lessons from that matter now. I don't want to talk about sort of bubble cliches and things like that. This is about helping investors understand the differences and the similarities. Okay. But before we talk about today's AI market, I want to just give a quick bit of historical context, because people keep comparing what's happening now with the dot-com bubble, and most of these comparisons are just wrong. The dot-com story was very simple. The internet arrived, people realized it was going to change the world, and investors tried to price 20 years of future growth into share prices of companies that had no profits and in many cases, not even any revenue. From 1998 to early 2000, the NASDAQ went vertical. Companies with nothing but a website raised billions, and anything with .com at the end of its name surged in value. Traditional valuation metrics were abandoned. Analysts talked about eyeballs instead of earnings, and expectations became entirely detached from economic reality. And then all of a sudden, reality arrives, and business models didn't work, profitability didn't appear, and the NASDAQ fell almost 80%. The technology survived, but the valuations didn't. So why are we bringing this up? Because headlines love saying we're in another dot-com bubble. Those headlines are everywhere. You don't have to look very hard to find them. But when you actually look at the facts, the moment is fundamentally different. And what I wanted to understand from you, Neil, because you've lived through both of these, is that yes, valuations in parts of the AI ecosystem are stretched, and yes, some expectations are entirely unrealistic. But this isn't 1999 for a few reasons. Talk to me about why the companies driving this cycle are different, why they're about the real profitable nature of them, why they're not pets.com, for example.
If you look at the sort of the leading global players in the AI industrial revolution, and really, I suppose you're really looking at a relatively small group of very large US businesses and a pretty small group of very large Chinese businesses. Of course, there are disruptors like DeepSeek, etc. But the companies that are leading the investment and are spending huge sums of money investing in AI infrastructure, these companies are the biggest, most profitable. These companies have the deepest financial pockets globally. That some of them are bigger than countries. I mean, Nvidia's market cap at $5 trillion, or just under now, it's about $4.6 trillion. It's bigger than the GDP, I think, of certainly bigger than the UK. I think it is even bigger than the GDP of Germany. Look, so there is a huge difference. Really, the point I'm making here is that the companies leading this industrial revolution have huge financial resources. They have cash flows from incumbent businesses. That gives a resilience and a longevity to the fundamentals of this this industrial revolution, which was not the case back in 99, 2000. That doesn't guarantee that all of the infrastructure spending that's going on will deliver an appropriate return. And this is an issue I've had some concern with. I just don't know. I don't have the information available to me now to make that call. And that's why I'm standing back from these big players where valuations have got out of hand, in my view. They're now starting to spend huge amounts of money on AI infrastructure. Now, that will involve some level of borrowing. And of course, they are now beginning to use their incumbent size, cash flow, and profitability to borrow money to invest in infrastructure. But some of that infrastructure is being funded by cash flow. I mean, it's just not the case that this is all driven by an illusion, which is certainly the case for many companies back in 99, 2000.
Well, the spending is certainly orders of magnitude larger than in 1999. So data center capex today, as you said, is bigger than the entire infrastructure budget of many mid-sized countries. That just wasn't true in 1999. There wasn't the sort of level of peripheral spending and the spending on picks and shovels suppliers that, for example, that we have now.
No, so the scale of the investment is very significant, but so is the scale of the opportunity. It is undoubtedly true that this technology will have a profound influence on every industrial sector, on every household, in every developed economy globally, and it already is having an impact.
I mean, you could say the same about the internet, though. The internet has too.
Yes, it has, but I don't think that the impact of the internet was quite so ubiquitous. I mean, the internet predated, of course, the tech bubble. Internet infrastructure was being built out before the tech bubble exploded. But the scale of what we're talking about now and the ubiquity of what AI will mean for us all is, I think, more profound than the internet infrastructure.
So your view is that the AI technology is delivering value now and it's not the promise of value in 10, 15 years' time?
I don't know how many customers OpenAI has with ChatGPT, but it's not far short of 1 billion, I believe.
Over 812 million users.
It won't be long before it's 1 billion. I mean, these numbers are astonishing. These models are being deployed and used across the developed world, across household sector, across the industrial sector. And of course, at the moment, the economic model is not justifying the scale of the investment. There's one important thing to remember about the internet infrastructure. What people underestimated was the capacity of the internet infrastructure that was being deployed. The pricing model that people thought during the internet bubble, there were massive misjudgments made about the economic value of the online offerings, but also of the infrastructure itself. What we discovered is that a fiber optic cable had infinitely more capacity through technological evolution than we ever thought. So the capacity of the internet suddenly exploded beyond what was thought. And as a result of that, the economic value to the owners of that capacity obviously diminished. Their pricing model was undermined by, first of all, the capacity of what they built, but also the overbuild that took place at the time. Now, it's also the case that many of the internet offerings, this idea that we would all change our lives from an analog to a digital world, wasn't right. It didn't. Humanity didn't change in the way that people thought had to be the case, or people anticipated during the bubble's inflation. My judgment today is that we have yet to fully understand the ubiquity of AI. I think we're only in the foothills of the opportunity set. So I think it is really, really quite different. Now, of course, huge amounts of investment are going in to create the capacity to deliver the AI infrastructure that we will all need. But when you see just one model having 812 million customers, that this is a play for economic and industrial dominance, and nobody's going to jump off this bandwagon.
So you're not saying this isn't a frothy market. You're not saying there isn't a bubble. What I think we are saying is that it's a lazy comparison, that this is just the .com again, and that's wrong.
Yeah, it's a lazy comparison. Yeah.
If it does go wrong, it won't go wrong in the way that the .com bubble did. The mechanics are different.
I think it's inevitable that there will be disappointment, as this industrial revolution unfolds. But we haven't even started with the robotic opportunity yet. I mean, if you listen to Elon Musk, I mean, his ambitions for humanoid robots are astonishing. We haven't even begun to understand the opportunity set there, but also the AI demands of a robotic infrastructure. So a humanoid robotic infrastructure. So look, there are inevitably going to be disappointments. There are inevitably going to be investment failures. Not all of these global tech titans are going to win. Not all of them by any means. Some are going to lose. But from this, I still believe this has a long way to go. But my judgment is, if I can't rationalize the valuation of these leading AI companies with traditional valuation tools, then an investment decision to include them in a portfolio, to include them in a strategy, for example, an investor's decision, frankly, is a guess. It's a momentum trade. And I have never, ever wanted in my career to ever engage in momentum trades. So that's a challenge. But for investors, if they want to play the industrial revolution that I think that's unfolding right before our eyes, you don't have to go out and buy or put a huge amount of your financial wealth into the Mag 7. You can find many companies that are benefiting from this revolution that's unfolding in front of us, without paying through the nose, without buying companies on stratospheric valuation. There are lots and lots of companies, I think, some of them have performed extremely well this year, but you can buy many companies, or you can invest in many companies that are participating in this industrial revolution, that are on completely sensible valuations, okay? The other thing, of course, to remember is that although this whole debate about AI is dominating all sorts of conversations about where to invest, there's a whole world of companies that have nothing to do with, if you like, the deployment of the AI industrial revolution, but they will be beneficiaries of it because they will use it in their own businesses. And there are hundreds of businesses like that are trading on very low valuations that will benefit from AI, in my view, over the next 5 to 10 years. And of course, many of those are trading on ridiculously low valuations.
Back in January, you said that the Fed would basically sit tight, cautious, waiting to see the impact of Trump's tax cuts and tariffs. And it seems that that's exactly what they did. Did the inflation picture unfold the way that you expected it to?
Broadly in the US, definitely. I think for a period after Trump's initial announcement, clearly you would have guessed that if anything like what he was saying would happen came to pass, then inflation would pick up in the US in the medium term. But what we now know is, and this is what I said actually at the time, that if really it was a headline grabbing negotiating sort of tactic to announce these very, very high headline tariff rates. Other people have described it as Trump blinking, but who knows who knows the reality of how this story evolved, really. But my guess at the time was this is a headline grabbing negotiating tactic. Some people then said, well, he blinked. And what we now know is that the initial rates were nowhere near where we now sit. So the inflationary impact of the tariffs has been much less than people thought. And in fact, the reason that we've seen the Fed cutting recently is, of course, because the fears that they had earlier in the year about inflation picking up, even though they were a bit concerned about the labor market, kept them on hold. What convinced them to cut was that really the inflation concerns that they had earlier in the year didn't come to pass. So yeah, I think broadly right on the inflationary path in the US.
And then there was the UK. You said the MPC's inflation forecast was frankly ridiculous, that the UK needed several cuts and that we get them. We're now at 4% and the market's debating a December cut to 3.75%. Has 2025 broadly vindicated your view of the UK economy?
Yes, I think it has actually. Although I have to say, hands up, I got the inflation picture wrong. I underestimated the increase in inflation that we'd see as a result of the administered price increases, I've called them, that we saw as a result of the budget last October, and as a result of the utility price increases, particularly water charges, which increased 26%. In April. So I mean, I think I underestimated the effect of those. So I didn't see inflation rising as much as it has done. Fortunately, it hasn't picked up as much as the MPC thought or the OBR thought. So it looks like we're peaking at 3.8%, not the 4% that they were forecasting. And I think we've now seen the peak in inflation. Inflation will start to come down quite quickly in the UK. Now, at the start of the year, despite that error on inflation, I did say we'd have 2 rate cuts, one in August and one in November. It looks like, well, we've had one. I think we will almost definitely get another in December. I thought it would happen in November. It should have happened in November. We'll get it in December. I'm pretty confident of that. So yeah, right, really on, although wrong on inflation, right on the interest rate outlook.
Sneaking in under the wire to get that final rate cut in. Neil, we had UK GDP numbers out today. What do you make of the data?
The number for Q3 was 0.1. I think the forecast was something like 0.3 or 0.2. I can't remember what the number was. But as ever, the headline number is one that I think you should completely ignore. Once again, the very curious way in which the UK Statistical Authority measures GDP has once again thrown up a completely weird anomaly which has distorted the Q3 GDP number. So let me just give you a summary. The 3 key elements of the economy which account for, in terms of expenditure, I think 90+% of the economy were up 0.5% in Q3. An acceleration on Q2, I think, when they were up 0.4. So underlying, the UK economy accelerated in Q3. The headline is that we barely grew in Q3. Now, the reason that the Q3 number's been dragged down is precisely because of something that most people don't really understand. Let me tell you what it's called. It's called acquisitions less disposals. And this is influenced principally by things like gold, for example. How much gold we bought, how much gold we sold as an economy. I mean, it's a bizarre, very volatile series. I absolutely guarantee that the number will be revised hugely in the future. But it is the underlying 0.5% growth in Q3 GDP has been dragged down to 0.1 by a huge decline in acquisitions less disposals. It is, frankly, a distortion. What people should emphasize and focus on is what's going on in the underlying economy. And as I say, household expenditure, government expenditure, business investment in particular was up 0.5%. What you can see now is that businesses are investing in AI infrastructure in the UK. They're embracing AI into their business models to enable them to become more efficient, more productive businesses. And as a result of that, they're shedding labor because the cost of employing them has gone up so much, but also because they're deploying AI and effectively replacing labor with machines.
Right, let's move on to equities, because this next bit is where your early year calls were at their most contrarian, I think. And I've got a clip from January that I think frames it perfectly.
It's the elephant in the room and utterly dominant in any discussion about global asset allocation. Of course, the question is, well, what happens next? We need to look at the lessons of history. There is a very clear correlation between the price you pay for an investment and its expected future return. The US market is currently trading on a P of 22. According to history, the next 10 years return should be something close to 0% real return. When things have done well, people expect it to carry on doing well. I would be significantly underweight in the US. I would not own the S&P 500 in any sort of index form, and I certainly would avoid the Mag 7.
That was your view at the start of the year. The US was expensive, long-term returns would be low, and the Mag 7 were carrying too much of the index. Do you feel even more strongly about that call now?
Yeah, I do. I've looked at a lot of videos recently, several this morning about the AI bubble, and lots of people are very, very skeptical. They are promoting some pretty strange arguments about it, I think, that are wrong. There's been lots and lots of talk of AI bubbles, and although I see the foothills of a bubble beginning in AI, I don't think right now, frankly, looking forward, this AI industrial revolution and the excitement around AI has a lot further to go. I think it would be wrong to swallow that slightly alarmist nonsense, frankly, because I don't think it's well researched and it isn't good analysis, frankly, what I've seen anyway. But valuation is the thing that guides me. It always has guided me. It guides me now. There is a lot of excitement reflected in the valuations of all of those companies. Many of the large companies that are focused on AI, and I don't understand really. I cannot compute the valuations. I don't understand them. I cannot justify to myself the validity of those valuations. I may be wrong, but history tells me that leaping into that sort of, well, everybody's jumping on board, so why don't you, concept is fundamentally flawed. And when valuations are as high as they are in the Mag 7, you've got to tread with caution. Now, the reality is that this year, the S&P has done okay. It's up 16%. The Nasdaq's up over 20%. And the Mag 7, after falling significantly earlier in the year in April, I mean, they were down significantly. I think all of them, bar possibly Nvidia, were down over 20%. They've rallied very strongly on the back of this sort of building AI excitement, and they're up mostly over the year, not all of them. So, this has not been a bad year for the S&P, and it's not been a bad year for the Mag 7. Interestingly, the other call I made was that other markets would do better, and that's been true. But anyway, look, I still remain cautious. So even though we've had another good year for the S&P 500, I would still steer clear.
There was a piece of analysis that I read this morning, which I thought was interesting, and that was that if you look at the Mag 7, there's still been a broadly positive return on those stocks this year. If you look at the AI sector, minus the Mag 7, that sector has actually, significantly outperformed the Mag 7 itself.
Yeah.
Is that the kind of thing you expected to start to see happening?
Yeah, that's why I said at the start of the year the way to play the AI industrial revolution was not to jump into the obvious plays where I thought a crowded consensus has moved valuation to pretty unsustainable levels. I said, look for the picks and shovels suppliers to the AI industrial revolution. That's what I believed in. I could see valuations that didn't reflect the excitement that I saw coming. And so I selected a range of stocks that I thought would do really well as a result of the demand that would massively increase as the infrastructure was built out to deliver the AI industrial revolution. The suppliers to that infrastructure build would, in my view, do really, really well. Now, NVIDIA is the most obvious player, and I wanted to steer clear of NVIDIA because I still don't get the valuation. But there were plenty of other stocks like Micron and SK Hynix, which I thought would do really well, and indeed they have done very well.
If someone's holding a plain vanilla S&P index fund today, what do you think is the biggest risk that they're not seeing?
Over a third of what they own is the Mag 7. That's one thing. Somebody might think that the S&P 500 is a very diversified index of US companies, and to some extent that is still very true. But the S&P 500 is dominated. 35, I think, % of the index is now represented by the Mag 7. So to some extent, you've got a very crowded bet on the fortunes of those 7 businesses. I'm not trying to be apocryphal about the S&P 500. I don't think it's about to fall off a cliff. I've said that repeatedly. I do not think the S&P 500 is about to collapse in a heap. If I did, I'd be more cautious about global markets anyway, because of course the ripple effects would spread out across all markets. Okay. All I'm saying is that there's an opportunity cost to holding the S&P 500. And that there are greater opportunities elsewhere is really the key message. So if you are crowded into the S&P 500, you're crowded out of other things that I think will continue to do better.
Well, that brings us nicely to taking a look at the global picture, because when you look at how the major markets have actually performed this year, it is quite a different story to what I think most investors would have expected. So we've talked about the S&P 500. As of this morning, when I pulled the numbers, it was up 17.7% year to date. The FTSE 100 was up 19.9% year to date. But China's index, the CSI 300, is up 23%. When you set those against your January view that valuations mattered and a decade of US dominance couldn't continue, is that broadly what you expected to see? Has this year panned out as you expected?
It's been a bit better than I expected, I have to say. I wouldn't have called that sort of return from either the UK index or China. I'm just because I suppose we've been conditioned to expect lower returns. I did say at the start of the year the UK would outperform the S&P 500, and I also believe that China, and when I talk about China, I'm talking about Hong Kong is the index that most represents the sort of companies that I would be most interested in. I'm not really interested. I don't want to be exposed to the Chinese domestic companies that are essentially government controlled. Most of those are listed. Those are typically listed in the CSI 300. The sorts of businesses that the Chinese businesses the tech leaders in China are the ones that are essentially dual listed in Hong Kong or sometimes in the US too.
When you look at the Hong Kong index, it's up 37.9% year to date.
Yeah.
So
Hong Kong has led the way this year in terms of returns, followed by China. I did say at the start of the year that the Goldman Sachs view which was shared amongst many investment banks, that China had become uninvestable was wrong. I think China's come back with a vengeance this year. So that's been a good call. The UK has done very well. It as a developed economy index, if you exclude China or Hong Kong as developed economy, they're sort of, I would think, they're somewhere between an emerging market and a developed economy index. But anyway, if you looked at developed economy indices, the UK leads the way. The Euro Stoxx is up, I think, about 16% this year. S&P just above that, and the FTSE 100 is up just under 20%.
Well, sticking with China just for a minute, because I know your call on China wasn't just about the valuation. There were policy shifts that you said were going to be positive for companies in China as well, about the need to shift from property to consumption and channeling domestic savings into equities. Has that policy shift played out as you expected, or have there been other things driving the positive performance?
Just over a year ago, there was quite a lot of excitement when the government announced various measures. That then dissipated, really. And then the excitement sort of got going with China. I think in a way it was sort of catalyzed by what DeepSeek said, I think back in February this year. DeepSeek's announcements highlighted the renaissance really of Chinese tech, okay, and particularly AI-related tech. That combined with maybe a sense that China's policymakers would grapple with and would start to now target the economic issues that were most challenging to China. That combined with the excitement around the ripple effects of what DeepSeek said created a sort of more positive investment backdrop. So domestic investors obviously were quite excited about it and reflected that in the sorts of stocks they were going to, the sort of stocks that led that rally. And of course, some international money found its way back into China, into some of those leading tech names like Alibaba and Tencent, CATL, Baidu, companies like that. And they performed very, very well this year. So the market's done very well. I would say where I am now, I'm a little bit disappointed with the policy response. I think the intention is there, but it's all going a little bit slowly. I suppose China's policy environment moves quite slowly. I think the government now does recognize what it needs to do. But equally, the government is very focused on the next 5-year sort of economic plan. Is very focused on supporting China's technology dominance in various sectors, but also it's very, very focused on closing the chip technology gap with the US. China's technology industry is being encouraged to significantly reduce its dependence on NVIDIA chip technology and to develop its own domestic chip technology. And indeed, NVIDIA's business in China has pretty much gone to zero. It's really quite significant. Now, this focus on developing China's tech dominance has slightly overshadowed, I think, some of the other policy initiatives, which I think are important to get the economy growing more sustainably. We have yet really to see consumption growth start to pick up significantly in China. And that's the thing that I'm really looking for going forward.
So that means there's presumably more room for growth in China's economy.
Yes, there is. I mean, I'm not sure that I've ever believed the numbers, the GDP growth numbers that China produces. There isn't the same respect internationally, I think, for China's GDP, macroeconomic data as there might be for the US, for example, or the EU. I wouldn't include the UK at the moment, as we know. There's lots of problems with the UK macro data. But I think I wouldn't automatically believe that because the Chinese authorities say growth was 5%, that it was 5%. And there are other indicators I look to inform me what's actually going on in China, which is still a deflating economy, which still appears to have, there's a lack of consumption growth in the economy. Manufacturing industry and growth in exports, not to the US, is what's really driving the economy. I want to see more consumption than growth. Now, if we got that, I would become more optimistic about the Chinese domestic economic story. But in the meantime, what's obviously really, really important is the valuation opportunity in these leading China technology names, which are all global businesses, really, with one or two exceptions. And there, I think there is scope to see continued upside in those businesses.
Okay, well, we're going to do 2026 forecasts and expectations in another episode, so we'll save that for another time. But that is all for this episode of Noise Cancelling. If you aren't subscribed to the channel and you've enjoyed this episode, please do consider subscribing. It really helps the channel keep growing. You can find us on Spotify and Apple Podcasts. Just search for Noise Cancelling. And you can also find out more about Neil's investment strategies on W4.0 at w4pz.com. Neil and I will be back with more next week. So until then, take care.